In 2015, China had shocked the world with the crash of its stock market. What exactly then happened in China that the stock market went free fall in 2015? Following the period of closure during the early history of China, the modern stock market re-emerged in the early 1990s with the reopening of the Shanghai Stock Exchange and founding of the Shenzhen Security Exchange. By 2000, the Chinese stock market had over 1,000 listed companies, worth a market capitalization of nearly a third of China's overall gross domestic product. As more companies went public, investors rushed to the Shanghai and Shenzhen exchanges. The Chinese stock market and economy grew quickly, and by 2012, the number of listed companies between the Shanghai and Shenzhen securities exchanges had risen to over 2,400, worth a market capitalization of nearly 50% of China's real GDP, and included over 200 million active stock and mutual fund accounts. China's economic growth, however, was stunted by the 2008 global recession and its aftershocks. The Chinese government responded to 2008 recession with a stimulus. China's economic growth, however, was stunted by the 2008 global recession and its aftershocks. The Chinese government responded to 2008 recession with a stimulus package that would draw resources from both private and public sectors in order to fund an infrastructure build. Growth following the stimulus package was rapid from 2009 to 2011. Seeing the opportunity for a nationwide reinvestment into the economy through the stock market, the government developed a campaign that would entice everyday citizens to trade. It was referred to as Zonggomeng, which translates to the China Dream. This campaign was first conceived and pushed by China's paramount leader, Xi Jinping. The dream was one of overall economic prosperity. Then how did China's stock market crisis started? The government started urging its people to invest so people had the borrowed money. The government started urging its people to invest so people had started buying stocks in a big way and often on margin, which means with the borrowed money. As of that, the Chinese market stock shot up. There was a strong sign that the seemingly bull market was actually entering the bubble territory. A big reason for the stock market rally was that a lot of ordinary Chinese people began investing in the stock market for the first time. Unlike other major stock markets, which are dominated by professional money managers, retail investors account for around 85% of China's trade. These inexperienced retail investors dramatically increased the volatility of the market, leading to much greater fluctuations in the stock market than would otherwise be the case. The investors were making highly leveraged purchases with the borrowed money. Margin trading allows investors to take huge risks for big returns, but it also introduces a ton of volatility into the market. This practice, known as trading on margin, used to be prohibited in China, but then the Chinese government lifted the prohibition, changing policy to strictly regulate the practice of margin trading. It also happened that the vast majority of Chinese investors were individuals rather than large institutions, which added more volatility to China's stock market. The market was very volatile because of the herd mentality, as people rushed to move in their money and to move out of stock, sometimes all at once. That the Chinese stocks started tumbling and its market went into free fall. However, before reaching the ceiling on June 12, 2015, China's stock market had ballooned about 150% in a year. The Chinese stock market crash began with the popping of the stock market bubble in mid-June, starting on June 15 in the same year. A third of the A-value shares on the Shanghai Stock Exchange was lost within 1 month following the event. 2.6 billion US dollars wiped off Shanghai and Shenzhen composite indexes in the initial 22-day summer market rout. Major aftershocks occurred throughout. Around July 27, the Shanghai Composite Index fell by 8.5%, marking the largest fall since 2007. And again, on August 24th, which people call as Black Monday, the Shanghai Composite Index fell another 8.5%. Also, looking at the next day, on 25th of August, people call it as Black Tuesday, another 7.6% of Shanghai Composite Index fell. As much as the financial market was deeply affected by the crash, what happened to the investors in general? As more than 80% of investors were individuals who used their hard-earned savings to buy stocks, many had lost their savings and money during the stock crisis. What would the Chinese government responded to the stock collapse? The crisis had made the Chinese government responded to the stock collapse with heavy interference. The government responded to the stock collapse by essentially buying the stock, with the China Security Finance lent 42 US billion to 21 brokerage firms so that they could purchase the blue chip stocks. At the same time, the government injected a new stimulus of 40 US billion to foster growth in areas of the economy that needed it the most. On top of that, China has allowed half of the companies on the stock exchange to halt their trading shares, and China stopped any new stock listings over the weekend of the crisis. The other response from the government was the China Central Bank had cut rates to record low in an effort to pump more money into the system, and it controlled the shareholders and board members, prohibiting them from reducing the shareholdings via the secondary market for 6 months. Also, government was giving more options for the investors to back their margin trades. As many investors speculated on stocks, they would borrow money to buy stock because they thought the stock would go up and they would make enough money to pay back the loan and make a profit. Chinese investors now could pledge their homes as collateral. The government devalued the yuan because a weaker yuan makes Chinese exports to the US and elsewhere cheaper, so it would help to jumpstart economic growth. However, all the efforts provided have failed to calm the markets. According to the investment group Bespoke, China's stock markets have lost trillions due to the stock market crisis. And until now, China's stock market has never reached the highest, the highest before the stock market crash.